Welcome to Venture CFO Podcast, the show that takes your business to the next level. I'm CFO Stan, and today we are talking about how to create your future with funding roadmap. Last episode, we talked about how to pitch to smart investor. When you pitch to investor might want to know how much you need and when you need it, and when and how much is your investor returns. Today, we will deep dive into the funding roadmap. It could even figure out your company valuation. Let's get started. Let's imagine if you have a treasure hunt map for your business. The moment when you lay the map on the table, your team's dream of financial freedom slip in their mind. They pay attention to what is in for them and is resonate with your plan to success in future. Investors appear to optimistic of your vision to bring your business to the next level of IPO. You strongly believe this map could solve all your problems in retaining your talented key employee, and all you need is unlimited cash to capture bigger market share for 5 years. Why would you not want a map that could tell you, investor, how much you are worth now and what is in for them after a year investing in you? Because you will be 99% confidence in your equity funding mission. How about 1% left? Well, this all depends on how you consciously pitch to them and handle their doubts. I'm sure you can do that. That is why you are here with me to learn the funding roadmap. How many of you are tired of working hard on generating profits on the consumer market? What if your CFO knows how to get your business funded on the capital market with cash? Because you have the deep knowledge of market know-how. So capitalism is good, easy and fair to society because your team will gain the reward of your hard work. But often people are rich simply because they are inherited wealth and they know the capitalism and they are born in the privileged caste of that. Now, raise capital fund is your best chance to millions. I have a story to share. A PhD graduate, I know, become an immediate boss after getting a first grant from the government to build a startup. So he was stuck on inability to expand his business because mainly due to people problem, a high turnover rate. His product was well accepted by the market and it was disruptive to the regional business. Okay, this boss need a lot of marketing fund to get the word out to consumer that his product could save even more cost, more time. He learned that equity funding could solve both of his major problems. And attracting talent and cash flow. These two are the most major. He did a lot of research on how to pitch for funding and prepare a financial projection and marketing plans for 5 years in detail. This boss is still confused on what the investor want and how the valuation made sense. He had no idea how to structure a clear message about his company future. Yes, he is an engineering expert and excellent with mathematics, but confusion on share dilution and funding structure is still in his mind. He attended seminars and he was unable to make a plan for raising funds. He heard attendees who used the trainer's method to raise funds successfully in the first stage, but got trouble and get stuck on second stage of funding, overvalued at the first stage and over diluted in the first stage. Every boss was greedy, raised more than enough, and as a result, the company was overvalued at the first stage itself. The more the better. Do you really need that much? Do you include your pay? Or are you asking too little? How many boss raise fund say that it's easy? Believe me, there's a lot. But the question is, what next? What if I fail to deliver the next round? Because you cannot capture the market that you promised you would. Now, let's go back to the basic. Look at the funding roadmap. This boss need a funding roadmap that say what is your value now, and the right people to lay this plan would be CFOs, who was capable of handling investor relationship and provide financial strategies plan to transform business. How many of you are CFOs? Agree with me. CFO's main role is to make strategic decisions on finance, tax, and accounting for the CEO. Every CFO has its own method of valuation and unique way of calculation for funding strategy. However, it is just important to balance equity and debts and cash as well. So these three things, they need to balance. Equity is more expensive than debt. However, debt is less flexible than equity. Both should consult a corporate lawyer, licensed company secretary, or accountant before offering equity to investor. That is my advice to you. But now I'm going to teach you here how to use your future timeline to map across a business plan into a financial plan with reverse engineering method. So cash funded on your business now. So what is funding roadmap? A funding roadmap is a GPS for your business. It tells you are located financially and in which direction you are heading towards. If you want to ensure your company is heading the right direction and that you must taking the right step to achieve your long-term goal, the funding roadmap is a must to bring your business to next level. Cash funding on is a timeline methodology used to create a business funding roadmap. It contains 9 categories in the map for duration of 5 years. Okay, there's 9 vertical columns. Number 1 is called funding stage. Number 2, profit projection. Number 3, timeline. 4, capital raise. 5, new share issued. 6, valuation. 7, price per earning ratio. 8 is investment value of IPO. 9 is ROI, return on investment. You can download your free template at the link below so you will understand what I teach and learn what you want to know, how to cash fund it on your business. First stage is we need to know what is a funding stage at the first vertical column. There are many types of funding stage available to startup. Depends on the industry and the level of interest among potential investor as your source. It's not uncommon for investor to engage in what is known as seed funding or angel investor funding at the first stage. The funding stage can be followed by Serial A, B, and C funding rounds, as well as additional effort to earn capital as well, as long as it's necessary. Serials are necessary ingredient for a business that aim to level up, because merely surviving of the generosity of your friends and family will not be enough. Series funding rounds are stepping stone in process of turning an incredible idea into a global company. Reaching at IPO, you need to raise funds to capture larger market and bigger customer base and higher revenue at every single stage. So here's an example of some of the stages. First stage could be angel funding round. Second stage could be equity crowdfunding. Number 3 stage could be Series A funding. Number 4 stage could be Series B funding. Number 5 could be IPO funding stage. So I'll now move to vertical column number 2, which is profit projection. Projected income is an estimate of financial results you will see from your business in the future. Okay, this is often presented in the form of an income statement. To create a projected income, it's important to take into account of revenue, which is subsequently be reduced by cost of sales, gross of profit, and operating expenses. Cash funded ons for every single stage, its profits are placed at the various stages as you decided. Okay, so category number 3 is timeline. Okay, future goals are set in a well-formed condition to achieve the desired profit and valuation outcome will be in your timeline. The timeline is stated in a year or more than 12 months period. For each role, will with a total of 5 years overall. It could be 3 years, but let's focus on 5 years. All entrepreneurs have goals, and those who have their goals clearly set tends to store goals as memory differently and internally from those who don't have any goals. This is the timeline. What you have in the timeline is a way to program your future so that you achieve your goals, making what you want in the future turn into reality and undeniably strengthen your belief in accomplishment. So category number 4 is capital raise. Having a business idea is useless if one does not have enough capital to translate into reality. It's believed that a business almost impossible to start without money. Using your saving is one option, but saving eventually will run out. Thus, using your organic profit is the second option, but it will slow down your desired growth. And the market may have already been conquered by your competitors. Therefore, raising funds through other sources is important in order to finance all your business activities. Choosing the right source of financing is critical in each stage of this capital raising process because it eventually determines the success and the growth of any business. The effective skill of capital raising are required for obtaining funds quickly and efficiently through the most appropriate sources. So, be realistic about the amount of capital you need now. Optimism is good trait for successful entrepreneurs. However, the real world is often quite different from selling your first product, as well as belief of no competitors or competitors is lacking now. Therefore, estimate of required capital should be made as realistic as possible so that enough money can be obtained. Not too much, not too little. Otherwise, you are likely to make the usual mistake of asking for unrealistic amount. The cash funded formula for capital raise is at first stage is shown like this. Okay, capital raise is equal to valuation times new shares issued. Okay, so begin with the end in mind of your IPO stage. You have to assure your business will be at the stage of IPO even though you do not have the knowledge of and money now. So you are using your time to exchange for money and knowledge, right? So smart investors like VC are ready to give you the knowledge and money. Your time is valuable. So at the last row of the capital raise column is your realistic IPO fund raise amount. Okay. Turn to next column, new shares issue, which is 5. Okay. Share issue is a process by which company pass on new shares to shareholders who may themselves be new or existing shareholders. Company can issue shares to both individual or corporate bodies, and it will dilute the amount of existing shares. First stage would recommend around 10 to 20%, and at IPO, certain stock exchange market may require a minimum 25% of new share issue. The cash funded formula for new share issue is new share issue equal to capital raise divided by valuation. The relationship between capital raise with new share issue is exact percentage of the company valuation. This means the more capital you need, the more share will be diluted from you. On the contrary, the higher your company valuation, the lesser new share issue, which means you don't need to dilute too much of your share for new investor to join your cause. Simply means you only need to dilute small fraction amount of your share to raise exact amount of capital you need if your valuation is high enough. Like what you hear so far, make sure you never miss a show by clicking the subscription below now. This podcast is made possible by listeners like you. Thank you for your support. Write to me if you have any questions so far or you want to share a story or collaboration with me. Do reach out with me and my team. Now, back to the show. Okay, vertical column number 6 is PE ratio. This is the ratio of a company's share price to the company's earning per share. The ratio is used for valuing companies and to find out whether they are overvalued or undervalued. The formula is price earning ratio equal to share price divided by earning per share. It can be interpreted as amount of the time over which the company would need to sustain its current earning in order to make enough money to pay back the current share price. The price per earning ratio is the most widely used method for determining whether shares are correctly valued in relation to one another. However, the PE ratio does not show an indication whether the share is a bargain. The PE ratio depends on the market perception of the risk and future growth in earnings. A company with low PE ratio indicates that the market perceives it as higher risk or lower growth, or both, as compared to a company with higher PE ratio. The PE ratio of a listed company shares is a result of collective perception of the market as to how risky the company is and what is their earning growth prospect are in relation to that of other companies. Therefore, in early stage, PE ratio tends to be lower as the PE ratio will be raised before the IPO. The example is your angel stage will definitely be lesser PE ratio than your IPO stage of PE ratio. So investors use PE ratio to compare their own perception of risk and growth of a company against the market collective perception of risk and growth. As reflected in the current PE ratio, if investors believe that their perception is superior to that of the market, they can make decisions to buy or to sell accordingly. Now, a bit of history. The US equity PE ratio from 1900 to 2005 is between 15 to 16. From 2010 to 2018, the PE ratio is between 16 to 22. The PE ratio of a company have similarities if they are within the same industry. Once the IPO has been raised, you will expect a significant higher PE ratio. For example, the PE ratio for Facebook in 2013 at high of 107.66. If you are a startup without earnings or revenue, you will use different approach to value a company. I will talk about that later. Okay, category number 7 is valuation. This is a general process of determining the economic value of a whole business or company unit. Business valuation can be used to determine the value of a business for a variety of reasons, including sales value, established partner ownership, taxation, and even divorce proceeding. Several methods of valuating a business exist, such as looking at the market capitalization, earning multipliers, or even book value. Among others, the cash-funded formula is valuation equal to profit projection times PE ratio. A company with higher profit and being in favor of industry with higher PE ratio would generally be given a higher valuation. So company without profit will have no value, which means it's unrealistic for a startup company or company who needs more than a year to be profitable. To use this valuation method, there will be a different approach in valuing a startup without revenue and profit. I will talk about it later. Next, number 8 is investment value of IPO. Pre-IPO companies can actually deliver extreme high returns. In last 10 years and after the dot-com bubble burst of the early 2000s, there have been a lot of high-flying companies deciding to undergo a public offering. That somehow now has changed recently. 2019, the market has inflection point in this trajectory with multiple noteworthy IPO in the US, such as Uber, Pinterest, Meet Beyond, Slack, PagerDuty, Zoom, CrowdStrike, and even more. Okay, ever heard of Masayoshi-san? Well, Masayoshi-san is sometimes known as Warren Buffett or Bill Gates of Japan. It is impressive how San had brilliant insight of pumping 20 million from his company's bank into Alibaba 14 years ago. This was a risk not even be taken by Warren Buffett or Bill Gates even before. At IPO, Alibaba company sold share in public on New York Stock Exchange, by which the value of the investment was set at 50 billion. So guess what was the investment value of the IPO of Alibaba Group 40 years ago? Yes, 50 billion. Imagine how much if you are invited to put in $100, you get back $250,000. In short, the investment value IPO is the future value of a company at the pre-IPO stage that you decided to invest in as of now. If you have not downloaded my free template, you could pause now and you will have to have a detailed view of the cash funded formula on. And you can simulate yourself easily by looking at this chart here. Okay? Yeah, take a look. Okay, the last one will be number 9 category, which is called return on investment ratio. The ROI measure the gain or loss generated on investment related to the amount of money invested. ROI is usually expressed as a percentage and is typically used for personal finance decision to compare company profitability or compare the efficiency of a different investment. The ROI that the SoftBank just now made is 2,500 times within 40 years. He invested 20 million, but his ROI was a whopping 50 billion. Okay, with cash funded on, the ROI could be calculated with the following formula. Okay, listen carefully. Is ROI equal to investment value of IPO divided by capital raise? There you have it. Now, you know all the category of funding roadmap. It's time to create your future. Master trainer Dr. Ted James once said, he trained people in reaching their goals successfully. Has 3 important things. Number 1, take responsibility for where you are. Write down what you want. Number 3 is program your future by creating memories for your future timeline. If you are ready, download the template here. There's 9 categories for cash funded on step. That is for you to follow in sequence so that you can create a well-defined funding roadmap. Okay. Number 1 is set your goals smart. Number 2 is program your timeline. Number 3, step number 3 is know your value. Number 4 step is begin with IPO in mind. Okay. Number 5, be resourcefulness of new share. Step number 6, estimation of PE ratio. Okay. Step number 7, your capital is my valuation. Step number 8 is create investor future at IPO. Step number 9 is how many times of ROI. By now, you should have a clear view of how a funding roadmap is created. The numbers will tell the story of what you will achieve. What if you fail to reach your target where unexpected circumstances arise? Investors that trust you will constantly be supporting you if you are genuine, unless you are a con artist who turns this into an unethical fundraising. Yeah, as long as it's ecological, I strongly believe leveraging smart investors' smart money with your smart goals is every entrepreneur should learn. There are people learning financial roadmap who became overwhelmed with their valuation at the first miracle stage, but they got stuck and then failed to proceed to the next stage. I want to emphasize that trustworthy is so important because anyone can get smart money, but the next thing you need is make sure you have a strategy to deliver what you promise. A business owner on strategy roadmap to bring your people towards the milestone planned with OKR and KPI. You might say, I'm just a traditional business without any technology, okay, not using online. I cannot raise funds from investors. Investors are more interested in disruptive technology business. I can prove to you wrong. Just look at Shark Tank and Dragon Den. Regardless of technology, Investors are more interested in investing honest people like you and me, right? VC simply fund any good authentic project. I know some of you do not dream of raising an IPO. That's right. This cash funded fund formula is for those who are open to an idea of merger and acquisition. For instance, if you have a roadmap ready, all right, you have done the financial roadmap. If someone offer you to acquire your business in 3 years down the road, you could use the valuation at the third funding stage as a basic of negotiation before a proper due diligence is carried out. If you still cannot picture your self-funding roadmap, this could mean that you have limited belief on your future profit, revenue, and valuation. Cleaning up any past memory not consistent with what you want and getting a business coach with the skill of timeline therapy could be helpful to you. And you can reach out to me. Okay, thanks for joining us this week on Venture CFO. Make sure you visit our website www.cfostand.com where you can hit the subscribe button below so you will never miss a show. While you are here, if you found value in this show, we appreciate a rating, or you simply tell a friend about this show. That will help us too. If you like this show, you might want to check out our book, Next Level Boss, The Secret. CFO Stand is available for private coaching.